Hi everyone, and welcome to question 5 of our business finance homework, the hardest one out of all 7 to complete. And today we're going to be focusing on the zero growth model, the constant growth model, as well as the supernormal growth model. Each one of these is pretty valuable for the evaluation of stocks in the future, so let's dive right in. Intel Corporation currently pays a dividend of $1.30 per share, or D0 equals 130. The required rate of return for investors on an Intel stock is 11%. An analyst by the name of Phillip Dupree estimates that Intel will pay out their earnings as dividends in the future. Intel Corporation has a long-term average return on equity of 12% and a debt ratio of 40%. Based on the future dividends and Dupree's assumption, what would you estimate as a fair value of the share for Intel's common stock? For this one, it is a little tricky because at first you look at it and you say, hey, I want to use that 11%, but that would be wrong. Also, you're going to completely ignore this debt ratio at 40% as it is just a red herring. Solve this one, we're going to be looking at our initial dividend of $1.30, and we're going to look at our ROE that is projected out by Mr. Phillip Dupree at 0.12 or 12%, and the only thing we're going to do is divide those suckers. Get a total of $10.83, and again, this is for your zero growth model or any type of dividend that has a zero growth. Next up, we have our question B. An analyst by the name of Raza Ali estimates that Intel's dividend will grow at a constant rate of 8% forever. Based on the future dividends and Ali's assumptions, what would you estimate as a fair value of the share of Intel common stock? We're going to be using the constant growth model for this. Originally, we had said that the dividend will be $1.30. We'll enter that in here. The constant growth, we're going to leave at 0.08, which is what Mr. Ali is suggesting it will be. The annual required rate of return is, again, 11%, as stated up above. We then have our calculations. Number one, we're going to figure out what D1 is, or the dividend at the end of the first year, simply by multiplying the dividend times the growth rate with a little 1 in front of there, so it's an increase of 8%. Then we're going to find our current stock price by taking the 140, or the dividend at the end of year end, and dividing it by the subtraction of the annual required rate of return against the constant growth rate, giving us a total of $46.80. Next up, we have C, which is the hardest one to do out of all of them. Intel Corporation currently pays a dividend of $1.30 per share. The required rate of return for investors on Intel is 11%. An analyst by the name of Bill Bachman, that's a pretty good name, that Intel's dividend will grow at a rate of 45% over the next 2 years. Then the dividend will grow at a constant rate of 5% thereafter. Based on the future dividends and Bachman's assumptions, what would you estimate as a fair value of the share of the Intel common stock? Seeing as though I'm sure Mr. Bachman has done his due diligence, he's very positive about this growth rate. So let's dive right in here. This sheet will also be available via our Facebook fan page, and I'll put the link in below. And this is actually quite a difficult problem to kind of talk through. So what I did is I made a little cheat sheet for all of us to use. And let's unhide a couple of these cells so we can see where the action takes place. First off, we're going to enter our dividend per share right here at $1.30. We already have used the rate of return at 11%. And the initial years are actually equal to 2. So inside the problem, we see that the initial Intel's dividend will grow at a rate of 45% over the next 2 years. For this one, you will actually just take the initial years and make sure you put the value inside cell B42 in this case. Next up, we are going to select our percentages over those particular years. So since we know that the growth rate will be at 45%, we'll add 45 here and 45 here to signify the first 2 years. and then thereafter it will be at 5%. And what this does is some crazy calculations in figuring out what the present values of everything are at. And again, this will be available to you via our Facebook page. And here we see that it will automatically select the correct formula for us. We'll be using the calculation 1 there. And then at the end, for this $2.87, it actually becomes $38.82. Let's just highlight how that works. And we're going to simply sum this up and end up with $42.74 right here. I made it so it would be good for the first 10 years. If there's anything after, we can always add in extra rows for it. However, it is pretty simple. The trick with using this particular model, you want to make sure that you don't forget to keep the initial year at 2. Otherwise, it will be completely messed up for you. Hope this answers all of your fun questions. Good luck with this one. If you have any questions, feel free to email me at wbach3@cox.net. Thanks for watching.